too much of what we talk about is mainstream, and this is in fact the squeeze. What you could get next, a weak rally, for example. It's been very dead at those low levels. This is not much price action. Given how hard you came down, if you were to be bouncing, you should already be bouncing. It's not happening. A weak rally sets up the flag, and we get our third impulse for a downside move. That ties in with a demand-destroying event where everything gets sold. You could also have news that's gold-specific. All gold holders need to register with a registered vaulting service, which will be on the blockchain for your safety, regular audits. Who knows? There could be a narrative that drives it. That could be gold-specific, or we don't even need that. It could be war breaks out. The other thing that's happened that I called, but I'd stopped watching because it was almost a fait accompli, was the gold to oil ratio. We said go. Everybody thinks all commodities are going to run. We said energy complex is not going to be good. We're actually mildly bearish oil, but very bullish gold. On the gold side, I think I was wrong. And I think most people are wrong. And I've looked at the technicals now, and you've got to be ready to flex. And I want to take you on a short tail, and it involves sharing the chart of how things panned and where we are and why I'm doing the unthinkable. I'm going to upset everybody here. The stackers, and I'm a stacker, by the way, the traders, because I'm going to do a 180, and everybody, well, not everybody, but the less understanding, or the people that don't understand technical analysis, resent a 180-degree turn always. Flip-flopping is a virtue in technical analysis. It's a sin in most other things, especially politics. And I'm going to make the case for why actually I'm turning to the fact that we could be facing the period where the demand-destroying event comes. That is this coming August. We're talking on the tail end of July, and we've got August to wait. But I also want to be sympathetic. I really love Eric's work. And I want, after this, just, I want to hear all of what he thinks. And it's going to be nice to hear his take as well. So I don't want to be overly dominant, but I need a bit of time to just show this charting.
Back in 2021, gold repeatedly tested the $2,000 level, failing each time before breaking out decisively. That fourth breakout was the catalyst many had waited years to see, launching prices toward $2,900 and even touching $3,000 during a period of remarkably low volatility. The rally coincided with geopolitical tensions, particularly U.S.-China trade disputes, which drove a panic out of debt and into hard assets. At the time, it felt like the start of a multi-year bull phase. But after hitting targets, the market began a progress decay phase, losing momentum until a sharp, unusual spike disrupted the natural cooling-off process. In April, gold experienced a blow-off rally driven by peak U.S. tariff tensions under Trump. Rates spiked, the dollar unexpectedly weakened, and large U.S. institutions were revealed as major sellers of treasuries. This created a turbocharged rally to $3,850 intraday before falling back. That spike was more exhaustion than confirmation, a slap-in-the-face pattern that often precedes a reversal. The similarity to past bond market patterns is striking. Strong rallies fueled by panic, followed by heavy sell-offs. Once that adrenaline faded, gold failed to sustain higher levels, suggesting the spike was less a new trend and more a final gasp.
So if we just show you this, Danny, and I was with you on your show, and everyone was very benign round about this time on gold, when we just had a technical break of 2000. We'd had since 2021 a lot of failed attempts. So let's just remind everybody on the broadening structure. So this is technical analysis a la the market sniper. And this was a continuation pattern, but it was a lengthy one, and it was a ball breaker, because you had that 2021 run, you had a down leg. You had an attempt here, it got beaten back, you had a down leg. You had an attempt here, which tried a couple of times in a virtuous period, and you had a down leg that still took you to 1800. Once, twice, three times, and then we said we said this particular winding up structure that was sitting and supporting on 2000 after the fourth break, which was the key break for us, was going to be your golden opportunity for a target, and we spoke 2,900, 3,000 back then. And that was the target. It came from this flagpole that's off there, and that goes all the way up to there, and there was the 3,000 level. So that was our call for the target, and we repeated it. This is now a year-old clip, November 24, my apologies, April 24, and we're already, a year plus on that. That break began, and we were having a pre-chat now, and Eric was saying, you don't get things going straight up. This was about as good as you get for almost straight up if you look at it. Very low vol, couple of winding ups on the way, and then you did your 2.9, you ran your 3K, and then you started what we typically expect, a progress decay, a little bit of slam back. But what happened around April 1 year later? Something unique. We had peak Trump tariff tantrum. This is when he was attacking China, Europe. Forget this recent European deal. We can talk if you want to about that.
The Liberation Day.
Yes, that's right. He was doing all of that. What happened? A prediction we had made in September 22 when Truss and Kwarteng were thrown under the bus and the pound collapsed and then bond market collapsed. We said that moment for the debt markets is coming for America.
When too many traders stand on the same side of the trade, markets tend to tip the other way. The once contrarian gold over bonds argument has now gone mainstream, echoed by prominent analysts like Luke Groman and Clive Thompson. This shift in sentiment makes the trade vulnerable. Compounding the risk, silver and platinum lease rates have surged, possibly hinting at supply stress or deliberate market constraints. Historically, such conditions often precede corrections rather than accelerations. If gold fails to rebound meaningfully soon, it could set the stage for a classic bear flag, leading to a sharper downside move than most expect.
Trump went peak tariff tantrum. The bonds rate spiked, the valuations down, and instead of the dollar going up on those interest rate climbs, the dollar collapsed. And that's where then certain people said, well, the Japanese, the Chinese, somebody else did this to them. In actual fact, it was later shown Americans in America were the biggest sellers of A, the treasuries, which caused the rate funk, B, dollars, and moving it elsewhere. But let's ignore who got scapegoated. That led to what is almost a turbocharged blow-off spike there. The Trump tariff tantrum of April, that gave us a baby's breath only at 3.5. We traded 3.5 for a second. So our targets of 2.9, 3K were good. We started to sell off, then an event intervened and gave us an exhaustive throw up. Okay, initially when I was looking at this pattern, now I need to drop time frames. I was like continuation, bull bias, debt is a busted flush, etc., etc. But then I'm also listening, and I'm going to give you the social things. George Gammon's channel, what if they re-rate gold to 20K? Clive Thompson, $15,000 to be re-rated. Recently, Luke Groman, for example, all good analysts, but I'm not knocking anybody out, all good analysts, lauded in Zero Hedge for saying what we said in 2020, that there's reserve asset substitution away from debt into gold. This is it. Look how well it explains it. This is all coming out. So we're no longer fringe. We're mainstream, all our takes, opinion, and too many people are standing on my side of the boat. Then you listen to SLV, no borrowing, lease rates up on platinum and silver. One, it could be manufactured, or it's true. If it's true, they're not going to let us win out without a fight. So that's a bit of fundamental and a bit of what I call sentiment indicator. Initially, we said this was a bit ascending for us. We discussed this in the community, but if it breaks, we're going on an upside. It broke. We were taking high fives and being, the usual. Market will always humble you and make you reconsider. But I was doing it a bit for entertainment purposes. I'm walking around London, good triggering event, rah, 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 bit too cocky and confident. The momentum in terms of the way we got rejected strikes me as exhaustive. Don't forget, you had a real reason that everyone panicked out of debt, and you got a real exhaustive sell-off there that smashed you down there. That we typically call a slap in the face. And as I say, it mimics the technicals of the bond market, which I can show you if you're interested to see. This is a very similar setup. This momentum to the downside, there's your exhaustive sell there.
One overlooked indicator is the gold-to-oil ratio, which recently hit long-term targets predicted years ago. In 2020, the ratio's inverted head and shoulders pattern forecast gold vastly outperforming oil a call that proved spectacularly accurate during the oil price crash. Now, with that ratio target met, the indicator signals potential pullback season for gold. Similarities to September 2020's bond market setup are striking. Both show bullish chasers piling in late, creating unsustainable peaks. Once those latecomers run out of buying power, the price structure becomes fragile, and even a modest shift in fundamentals can trigger an accelerated downward adjustment.
There's the second one. Typically, they should get less when you're doing a volatility squeeze. The calming is part of the price behavior. That's why we call it the Hunt volatility funnel. It's the funneling down of volatility. That was a major surge that looked single-minded, and we were cocky confident. That engulfed it and is hard down. Now we have one pattern that is the hardest to spot, and we usually get it wrong, but we've learned to pivot quicker. And this is the bit where everyone hates you for changing your view or your take. And the truth of the matter is, it's a sign of a good technical analyst, but you'll not be loved for it. This is a slap in the face event that was driven by what I just described, the Trump tariff tantrums. When we had already made the 3K target and we're in a progress decay phase, we got this massive blow off. Now, too much of what we talk about is mainstream, and this is in fact the squeeze. What you could get next, a week rally, for example. It's been very dead at those low levels. This is not much price action. Given how hard you came down, if you were to be bouncing, you should already be bouncing. It's not happening. A weak rally sets up the flag, and we get our third impulse for a downside move. That ties in with a demand destroying event where everything gets sold. You could also have news that's gold specific. All gold holders need to register with a registered vaulting service, which will be on the blockchain for your safety, regular audits. Who knows? There could be a narrative that drives it. That could be gold specific, or we don't even need that. It could be war breaks out. The other thing that's happened that I called, but I'd stopped watching because it was almost a fait accompli, was the gold to oil ratio. We said go. Everybody thinks all commodities are going to run. We said energy complex is not going to be good. We're actually mildly bearish oil, but very bullish gold.
The coming months could bring a demand shock event, forcing liquidation across multiple asset classes, gold included. Potential triggers range from geopolitical conflict to new regulatory measures requiring gold registration and blockchain tracking. Whether or not such events materialize, the technical structure points to a possible short-lived bounce, followed by renewed selling pressure. Traders who can pivot with the charts will be better positioned than those clinging to outdated narratives. Gold's long-term case may remain strong, but in the near term, caution, not complacency, could prove the most valuable asset of all.
Now, we said draw the inverted head and shoulders here. Here you go on gold versus oil. So that's gold divided by oil, weekly chart. We said you should make these targets here, dual targets up top there. This was, don't forget, you had a low when oil was 129 and gold still hadn't broken out the 2K. That was 14 barrels you got for 1 ounce of gold. The neckline was 28. We said you should be making 52. I missed that. It actually had already run and happened. This is the thing, we get so excited and we're in the bull market, we're all watching the 15-minute chart and the 5-minute chart in the ever pumpamentals of the run-up, and key targets have been dropping that were set. And for people that think, technical analysis, that doesn't work, okay, it's done that. That head and shoulders is part of the reason we called the previous. We said oil to trade single digits, one of our biggest known calls that we're famous for. On a stage, we've got 2 recordings of it. We said at $67, we see a single digit oil. People are not pricing it suitably. It hasn't been there for 35 years. I know I sound insane. It could happen. There's that head and shoulders that did it. It went to infinite. If you did that trade that we called, the same trade, long gold, short oil, you had the 21 pump high of gold and you saw the collapse to zero, never traded at zero before, which was obscene. Okay, it was CV19, it was kind of lucky, but that was the most extreme right we've ever been. And that target is now made, it tells me pullback season. The bond market, our other most famous call, is always the difficult. September of 2020 looks exactly like that gold chart. What happens is the money chases in. The money keeps chasing in on the ascending part here. because they say, oh, it's cheap, quick. The late bulls are coming in. The late bulls are coming in. Each bounce, late bulls. Then you try run and bang, you get spanked.